What's going on? It's Ryan here, CEO and head quant at happytrader.io. We have a huge downtrend signal, and I'm going to show you how to make a bearish play using calls. Okay, so usually when you think about calls, you're thinking in terms of the market going up, but we're going to be selling calls. We're going to do a call vertical spread, and it's going to be otherwise known as a bear call vertical spread. And you can see that we're using the macro trend, which is working very, very well. The downtrend signal that we had all the way back in the kind of mid-October really ran. And on this 45-minute chart using happytrader.io, which is our indicator, it's giving us a heads up that the market is definitely looking to make a downtrend. Similar, maybe not similar in amplitude to this uptrend, but maybe similar to this one because of how close this downtrend signal is. It's literally superimposing over the buy signal, right? So let's get into the strategy, which is the call vertical spread, and we're going to get into the power E trade options chain for this, and we're going to look at the SPX. So what can you do as far as this type of trade? Well, a couple cool things about this trade. The first thing is that you can pretty much put it on anytime. So if you put it on, let's say, 0 DTE, meaning 0 days to expiration, and you do a call vertical spread and you just flip around, and let's just check to make sure our expirations are dialed in. And you can see that the options chain below is already populating just one strike width. And you can see the snapshot analysis here. You can see about a 1 to a 1.56 call vertical there, and you can see that if the price of the market goes down and we expire even today with almost no premium, it's literally 3:33 p.m. If we expire and this price, this dotted line, which is the price, goes anywhere near this ridge, over this ridge, at this ridge, you collect full profit there on just that one spread with an excellent risk reward. So that's one way to trade, is an at the money call vertical. It gives you roughly a 1-to-1 risk reward depending on the strikes that you choose. So let's go into another scenario where we're a little bit further out, and we could take the over the weekend trade if we really wanted to be brave. And again, this isn't financial advice. I'm not telling you how to trade. I'm just teaching you what I know about trading, and that's what we're going to do. So now if we go all the way out 4 days out, we can see that there's a lot more premium on the table, obviously, because there's all that weekend risk, there's news risk. That's all baked into the market, right? So options chain, everything's baked in. So what you can do as far as on the call and the put side is you can go into the the options chain here, and you have the opportunity to get further out of the money. So you can see we're at 46.85 here. You can actually get way up into these higher deltas, and you can see, look, we can get all the way to 47.35 and still collect some premium. I like a little bit of meat on the bone, so I would probably do a trade like, let's just say, maybe a 12 delta for like an over the weekend type of trade. And again, I'm not telling you to trade over the weekend. This is just something that I like to do, and I want to teach it to you. If you're using Happy Trader signals and you're actually seeing like, oh man, there's a downtrend and I have the alert on the 45-minute chart, what are some options that I can do besides just puts, right? What are some, strategies? And this is one of them. So what you can do is, let's just go back to the options chain. You can sell further out of the money when there's more time on the clock, right? So that's kind of cool. So what you can do is you could sell, for instance, the 47.20, and then you could, just buy the very next strike, right? Creating a spread. So this is going to be your call vertical spread. And we can see that this is set for January 8th. But let's look at the snapshot analysis here. And you can see, oh, that's the difference. So trading at the money is going to put you kind of right here as far as the dotted line. But when you sell a higher probability spread, you can see that the chance of maximum profit, probability of maximum profit, 76.93%, not too shabby, right? To collect 660, max loss at 440. So that is a way more asymmetric risk reward. But look, the trade-off for the asymmetric risk reward is that you are already sitting there in the profit zone and the market has to significantly gap. Now, can it gap? Yes. Are these percentages always correct? Not always, especially when there's gapping in the market. So I wanted to show you that strategy, and I just want to go over one more thing before we end the video. If you go out wider, You might be thinking, oh, well, why do you only want to collect that much premium? And I'll show you why. If you go to, like, let's say the 5 delta as your spread, so that'll be your bought call, we're going to go back into the snapshot analysis and look at the width. We'll hit edit and snapshot analysis, and you can see that now your max loss is really becoming lopsided. You can see that 1 to like 0.10, but you are still in the money. So technically, you can, up until you hit this strike and start breaching, you can lose, but look at all that room you have. So even if you're losing the trade, if by expiry, the underlying is roughly 47.14, you're going to collect that full premium, right? But do you want to risk that over the weekend, or would you prefer more of a 50-50 strat? That's going to be today's video. It's the call vertical using our happy trader downtrend signal, which looks like we are in for some bearish movement in the markets. It's Friday, January 5th. My name's Ryan. Have a great weekend and happy trading.